Hi everyone. Uh, we're going to be looking at purchase invoices today. We're going to be understanding what they are and how to account for them. Now, I have an example here. So I pay a direct debit of £100 per month for my gym membership. A bit expensive, not myself. This is just an example, not in real life. How do I account for this monthly transaction using double entry? Well, let's have a think about it. So we're reducing cash. What's the effect of that? Well, it means we have to credit cash £100. Now, what sort of thing is a gym membership? It's an expense, isn't it? Debit expense £100. Okay, so we do debit expense £100 and then that's us done. And yeah. Well, by the way, this topic only covers expenses. Okay, we're not dealing with assets at all. Now, most businesses don't pay expenses immediately. A supplier will normally send a purchase invoice first. Normally, it depends on the process really, depends on the type of expense, but normally there are lots of steps before the issue of the purchase invoice, like the organisation sending a purchase order saying, oh, we need these materials. But on the whole, the process we're interested in is when we get the purchase invoice. Okay. Now, what's the benefit of having a purchase invoice? It means that you have a document showing the amounts you need to pay. It's just supporting documentation for any payments you've made. If you get the invoice, instead of paying immediately, if you pay immediately, you're reducing your cash immediately. So getting the organisation to issue a purchase invoice actually delays any cash outflows to the business. Also, another benefit is if you need to recover VAT, if you're paying expenses, the VAT you're charged on them can be recovered. I know we're not covering VAT in this presentation, but I'm just showing you that there are benefits can be recovered. I'm just showing you that the commercial side as well, just to give you some context. And the invoice is helpful for this. In this case, there's no VAT, so we don't need to worry. Now, this is an example of an invoice. Invoices normally have a particular number. They can be traced. We have the organisation who's issuing this invoice, so this is a supplier, isn't it? This is us. They normally have a logo. This is the service, and this is the amount due. Now, the service is an expense, isn't it? It's a consultation fee. So I know I have to debit expense £1,000. But what I don't know is, where do I put my credit to? Because I'm not paying any cash, am I? Well, if you think about it, this is a liability. It means we owe money to this given supplier. And we have a type of liability account called a trade payables account. And this is a balance sheet account, as all liabilities are. So trade payables, we do credit trade payables £1,000. So it means we owe £1,000 to this given supplier. Now, so we know that we have to do debit expense £1,000, credit trade payables. I'm going to put TP for short, £1,000. How do we account for the payment of the invoice when the payment actually comes through? Well, we do. If we think about it, we're reducing our cash. So we're reducing cash and reducing our liability. the money we owe to zero. Well, the liability we're reducing to zero. So that means if we're reducing cash, we're doing credit cash. But where's the debit going to? The debit's going to go to trade payables because that's our liability. So it means we're reducing our trade payables balance. So in summary, it's debit trade payable, credit cash, £1,000. Okay, and that's us done. Now, here's what I want to highlight is that trade payables at a given point in time, say if at, we'll say this is at 5th of September 2012, okay? It's the sum of invoices outstanding at a given point in time. That's the way I think about it. So this means this is the amount outstanding. This is called an age creditors report, and I'm going to show you what this means. Outstanding at 5th of September 2012. Now I'm just going to call this less than 30 days so that we know, so that this is a bit clearer. Now this amount here, I'm going to explain what this means first of all. So this is a sum of invoices outstanding for more than 120 days. So that's how long? That's 4 months, isn't it? That's a long time. So if you're a business, you'd be wondering, why have these amounts not been paid? Is there some kind of dispute going on? If you're an auditor, you'd be wondering the same. It's normally not good business to, you just damage your relationship with your suppliers if you're paying them late. Okay, so if this is 1, if we think about it, this is going to be the same as 2 plus 3 plus 4 plus 5 plus 6. Okay, if you don't believe me, you can get your calculator out and try. And I think we'll just ignore this column. This is the main one. This is the one that we're interested in. Okay, and if for these reports you generate directly from your accounting software, you can break down at invoice level as well. I'm giving you, I know you might don't need to know it for the exams per se, but it's good to have, I think, some context. And when you're booking an invoice, you book it to a particular supplier code, so you can monitor how much you need to pay that given supplier. Okay, you generally use the same suppliers each month. Now, okay, so our first point is, we didn't touch on this, but this is good to touch on now, is that purchase invoices are a source document, which means that we use them to update our accounting records. Okay? When we account for an invoice, we put the debit to expense and credit trade payables. So account for an expense invoice, okay? If we're buying a plane, it will be a bit different. When we pay for the invoice, we're reducing our liability and we're reducing our cash. So debit cash this much and debit trade payables this much. And I want to point out that trade payables is the invoice amounts outstanding at a given point in time. Okay, thanks everybody. Hope you have a good day.